Schwab has big problems. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Schwab could be the next big bank to fail as mounting unrealized losses and fear of deposit flights target the big bank. And this is a story we're going to hear over and over about every major bank out there as people start to look under the covers at the financials of these banks and find out there are huge unrealized losses and the fear of deposit flight is massive. We're going to take a look at what's going on under the covers of Schwab, why this is a big fear for the big bank, and why the ultimate solution that nobody thinks will come will happen later this year. Plus, BlackRock, one of Schwab's biggest competitors, is now on the record saying there's no chance that the Fed cuts rates this year. I'm going to prove them completely wrong. And there's one sector of the economy everyone's been saying is totally immune to this banking crisis and economic downturn. And we just got news today that's saying that it's not immune at all. Let's head over to Bloomberg, where we picked today's story up with a headline: Schwab's $7 trillion empire built on low rates is showing cracks. And this is a key part to this story that I want you to understand as we go through this, that the entire banking business model is predicated right now on two things: low interest rates and lower interest rates. So the idea that the banking industry really wants rates to go higher, as we're going to see as we get into their balance sheet, they really need rates to either go lower, or if the Fed was to embark on a hiking cycle, they need to be very slow and very gradual, nowhere near the current pace the Fed is doing now. Rather, as the crisis drags on, investors are starting to unearth the risks that would have been hiding in plain sight. Unrealized losses on the Texas-based firm's balance sheet, loaded with long-dated bonds, ballooned to more than $29 billion last year. And again, this is kind of the same story. What did we hear out of First Republic, Silicon Valley Bank? We had even tied back to Signature Bank is, hey, they've got all these long-dated bonds they bought near the pandemic lows, and they're upside down on them in the worst possible way at the biggest size of unrealized losses in the history of the banking system. At the same time, higher interest rates are encouraging customers to move their cash out of certain accounts that underpin Schwab's core business model and bolster its bottom line in a major way. The business, though, Schwab says, is completely misunderstood and totally misleading to focus on paper losses, which the company may never have to incur, they said. Now, the question is, do you believe that? Because that was kind of the story we should have heard about Silicon Valley Bank and First Republic Bank. Hey, these are just paper losses. They're not a big deal, and yet all of a sudden they started to become, and then eventually did become a big deal. The question I'm going to ask you, weigh in the comments, do you think these paper losses matter, or Schwab says they're really no big deal? There would be a sufficient amount of liquidity right there to cover if 100% of our bank deposits ran off, according to the CEO. But get this, adding the firm, and this is where I kind of put into question in the same paragraph, adding that the firm could borrow from the Federal Home Loan Bank and issue certificate of deposits to address any funding shortfall. So the question is, which is it? Do they actually have enough cash to cover all deposits that they left, or do they not have enough cash because they need to go borrow not only from the government, but from their own customers to cover the flight? And Schwab is unusual among its peers. It operates one of the largest U.S. banks grafted onto the biggest publicly traded brokerage. Both divisions are sensitive to interest rate fluctuations. Now, the key part, something I want you to understand, is we're talking about the banking side of Schwab. Now, on the broker side, yes, there are people that do have cash positions in their brokerage account. But generally, if they're being managed or invested, they're relatively small. They're most commonly underneath the FDIC limit to begin with. So that's not the major issue, because those customers, if there was a problem, could simply go in and put a trade and move their money into short-term T-bills or some other investment and then make that cash disappear. It's the banking side of Schwab that suddenly has got everybody's attention. And like Silicon Valley, Schwab gobbled up longer dated bonds, as I pointed out earlier, at low yields during 2020 and 2021. Again, this is going to be common throughout the entire banking industry. That meant paper losses mounted in a short period as the Fed began boosting rates to stamp out inflation, which should give you a little bit of a clue to what I think is the ultimate solution here that the Fed's going to have to do. And yet 3 years ago, Schwab's main bank, much like all the other banks, had no unrealized losses on long-term debt that it planned to hold until maturity. By last March, the firm had more than $5 billion of such losses that climbed to $13 billion at year end. And so in turn, it shifted, get this, 198 or 89 billion of agency mortgage-backed securities from available for sale, meaning they could sell them at any time, to hold to maturity on their balance sheet that effectively shields them from those losses. And what that means is now they've got to hold them to maturity. So they saw all of a sudden, hey, there's a shift from the Fed and we need to insulate ourselves. And now these paper losses, well, they're not even have to count them anymore, because in a hold to maturity account, they don't have to show their unrealized losses, but we know they're there for sure. The rules governing such a balance sheet move are stringent. It means Schwab plans and has to hold more than $150 billion worth of debt to maturity. Get this, with a weighted average yield of 1.74%. And the lion's share of those securities, $114 billion at the end of 2022, won't mature for a decade. So now you're seeing that this problem that's plaguing the banking industry, as we start to peel back the layers of the onion and say, wait a minute, this wasn't just a Silicon Valley Bank issue. This wasn't just a First Republic Bank issue. This is a deal facing even big banks like Schwab and probably all the other banks as we continue to dig deeper in here. And what we're going to face is they're sitting on these unrealized losses, and it's going to be for a decade or more. So you start to get the idea is, if the Fed eventually figures out that raising rates is bad for the industry, that it is solely charge of regulating and protecting, it tells you already at the onset that perhaps that rates will have to go down and stay down for so long to get these banks out of the bind, or the Fed is going to have to come up with another program, with another acronym, to figure out a way to get these assets off the balance sheet until we can figure out a proper solution. At the roots of Schwab's income is idle client money. The firm sweeps cash deposits from brokerage accounts to its bank, where it can reinvest in higher yielding products. The difference is between what Schwab earns and what it pays out on interest to customers is its net interest income. And get this, 51%, a whopping 51% of Schwab's revenue is on interest income from customers just sitting on cash. If you can imagine that, what a great business model. At least it seemed like it until now. And after a year of rapidly rising rates, there's a greater incentive to avoid being stagnant with cash. While many money market funds, as we've talked about, the Fed's paying 4.8% on those money market funds it backs. Of course, with a cut to the money market fund, it's going to be a little bit less, while Schwab is offering 0.45%. It's only an open question just how much money customers could move away from its sweep vehicles, again, putting Schwab now at a risk of a bank run. But again, this is a story that's going to impact every bank. The question is all this money going to leave and go elsewhere? Could it go to the Fed's balance sheet? Could it go to the overnight repo? It absolutely could. And to plug the gap, Schwab saw this coming. The brokerage banking units borrowed a whopping $12.4 billion from the Federal Home Loan Bank system through the end of 2022, has the capacity to borrow $68.6 billion, and they've also borrowed an additional $13 billion from the FHLB so far this year. So it starts to kind of make you wonder, is if everything's okay at Schwab, why are they borrowing this money? Why are they doing this now at a time when they should be saying, hey, look, we told you if all of our cash leaves, we're okay, but maybe we're not, because we've gone out and borrowed some money, and maybe we could borrow some more money, and we could even borrow from our own customers and get them to say, stay. And it starts to make you wonder what the heck is going on here, because if banks like Schwab are facing this issue, imagine this flows down to even the smallest banks. Any sort of fear now that hits the banking industry is going to lead to deposit flight. Where the money goes will go to the stock market, the bond market, will go to other banks, will just go to the mega banks. We don't know exactly where it's going to go, but we do know when the music stops, some of these banks are still going to go under. And yet, keep this in mind, we're still not even in a recession yet, and that is coming. Now, for those of you who are on the CTA-Timer Pro report, we just issued a trade pick today. We're showing you how to use the report. We put out a video. If you're thinking about buying this, the price is still $30 a month, but I'm going to be raising it to $40. Everyone that's using it is raving about it. So again, check this out. There's a link in the description below. It's $30 for now. Check out that trade tip that I posted today. There's a video of it. And again, once you see how powerful this report is, it's going to be a fantastic piece to your trading arsenal. And now let's talk about what's going on over at BlackRock, one of Schwab's biggest competitors who's saying markets are wrong on U.S. rate cut bets, and now we're going to prove them completely wrong. We don't see rate cuts this year. That's the old playbook when central banks would rush to the rescue the economy as a recession hits. We see more nuanced phase of curbing inflation ahead, less fighting, but still no rate cuts. So what they're suggesting, and we've shown this in the past, is that their belief is that if there is a recession, which we can arguably agree that by the second half this year, we're probably going to see one, that there's no way the Fed's going to cut rates because they don't believe inflation's coming down at all. And yet we're going to give you conclusive proof that the bond market, which is something BlackRock should know about, is telling them not only are they going to cut rates, it doesn't matter whether we're in a recession or not, the Fed is going to be forced to cut. And here's a proof in two charts. Here we see the federal funds effective rate in blue against the 10-year, 2-year yield curve in red. Now, notably, what I want you to see is where the funds rate goes down in blue. You'll notice there's several points here where you see big declines in the funds rate. And what do you see happening at the same time? The yield curve is steepening. This is called a bull steepener. And this is when the 2-year yields fall faster than the 10-year yields. But it's this next chart. I'm going to flip the yield curve upside down because I want you to see what those at BlackRock need to be clued into is a yield curve leads the Fed, has nothing to do with inflation. It has everything to do with the bond market telling the Fed it's time to cut. And here you can see when we invert the yield curve, it makes perfect sense. As the curve steepens, now shown inverted, heads lower, you can see repeatedly it leads the Fed in each and every case coming down. And now it's starting to head lower. You can barely see it here in the corner, but now the yield curve, is steepening and we're showing inverted is heading lower, telling us that it's only a matter of time now between when the Fed is going to cut and when it actually is going to wake up to that reality that it's going to cut. And as we turn now to another sector of the economy, this is one everyone said was virtually immune to any downturn, any recession, any banking crisis. And now we're finding out it's not true at all. Home prices fell in January for the 7th straight month. This from the Wall Street Journal, as rising mortgage rates and growing affordability challenges have led to slower home price growth. Now, I'm going to take a beef with this statement here because in a booming economy, rising rates shouldn't matter because people are seeing their wealth increase. They're seeing their pay increase. And so if the cost to buy a home or a car or anything that's interest rate sensitive goes up, they should be able to afford it. Now, the part they do mention here is affordability challenges, which I believe that statement should be reworded to say the global economy, the U.S. economy is slowing, and because of that, people's pay and wages are not keeping up with inflation and therefore cannot afford these home prices. But if the economy was booming, they could. And now let's go to the man behind the report and see what he has to say. And behind the home price index, we get Yale economist Bob Shiller. He says, I would extrapolate the downturn somewhat, he said, is going to continue because home prices are very, very high by historical standards. And of course, you remember the last time they were high by historical standards. We know exactly where they went after that. He said, maybe if you have a good chance to delay your purchase, it might be a good time to do it, suggesting that sellers would be forced to cut prices, and he thinks it might get a little cheaper after 6 months. But in reality, Mr. Schiller, we're going to be in a massive recession in 6 months, and I don't think housing prices stay up. I'll let you decide. What do you think? Are housing prices immune this time, or do we see them plunge just like we did during the global financial crisis? And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.